Hello, fellow stackers, and welcome back to Gold Rush Reporter, your go-to channel for clear, no-nonsense analysis on gold and silver. I'm Conrad, and today we're kicking off something exciting, our silver giveaway. That's right, 20 ounces of silver are up for grabs this month. Here's how it works. Simply like this video, comment with your preferred form of silver or your 2026 price forecast, and subscribe to the channel. That's it. By the end of January, one lucky subscriber will walk away with 20 ounces of silver, so get your entries in as soon as possible. Now, let's get into the market, because things have been moving fast. If you stack both silver and gold, you already know how volatile silver has become. Over the past 6 or 7 months, silver has seen significant price surges, far outpacing gold and the broader markets. Some people are calling it a new silver squeeze, and with good reason. Physical supply remains tight, and global demand, especially from industrial and energy sectors, is growing. To help us unpack what's really happening, I'm joined today by Carrie Stevenson, founder of the Australian Gold Conference and host of Making Money Matter. Carrie, welcome back to the show. It's great to have you. Carrie. Thanks, Conrad. It's wonderful to be here. The last few months have been fascinating for precious metals. Silver in particular has been extremely active, and the conversations we're having today are crucial for anyone trying to make sense of this market. Conrad. Absolutely. Let's start with silver. Everyone's talking about it outperforming gold lately. Its price movement has been 4 or 5 times stronger than the S&P 500 in recent months. From your perspective, what's driving this? Carrie. There are several factors. First, the supply-demand imbalance is real. Physical silver is limited, and paper markets can only mask scarcity for so long. We're also seeing geopolitical tensions and economic uncertainty influence investors toward tangible assets. Finally, industrial demand for silver, especially in solar panels and other emerging technologies, continues to grow. Conrad. That's a good point. I experienced it firsthand today. I went out for a coffee, wearing my shirt that says, "Keep calm and buy gold." A man at the cafe noticed it and questioned the message. He seemed frustrated by the idea that precious metals hold long-term value. This highlights a common problem. People often act irrationally based on short-term headlines. Carrie. Exactly. And it's the same with silver. People hear rumors about crashes or temporary dips and panic. Meanwhile, the reality is that silver has long-term practical and monetary value. Unlike fiat currency, its supply cannot be inflated overnight, which is why it remains a safe store of wealth. Conrad. Speaking of fiat currency, it's becoming clear that governments globally continue to spend excessively, printing money to fund programs like Medicare, Social Security, and other entitlements. In contrast, silver and gold cannot be printed. This fundamental scarcity, coupled with rising demand, is what drives prices higher over time. Carrie. Absolutely. And for investors, that's why silver and platinum are outperforming gold in certain markets, even though gold remains the ultimate long-term wealth preservative. Conrad. That's an important distinction. People often confuse short-term price swings with long-term value. Today, 1 ounce of silver may cost 74-76 cents, depending on premiums. But over the next few years, its purchasing power can grow dramatically, especially for those who start stacking early. So, for viewers tuning in today, take advantage of opportunities like our silver giveaway, stay informed, and remember, stacking consistently, understanding supply-demand dynamics, and separating short-term noise from long-term fundamentals is the key to building lasting wealth. Let's dive straight into the heart of the silver and gold markets. Right now, silver is grabbing attention because it's not just a precious metal. It's also an industrial metal. That combination makes it extremely sensitive to both economic uncertainty and industrial demand. Over the past few months, we've seen prices surge, partly because physical silver is scarce, and partly because industrial demand keeps growing, especially in solar panels, electronics, and other green technologies. One important factor to understand is supply constraints. Physical silver is limited. While paper markets like futures and ETFs give the illusion of unlimited access, the reality is that actual silver is much harder to acquire, especially for smaller retail buyers. When governments or large institutions impose export restrictions, like China recently did on silver and silver byproducts, it tightens supply even more. That combination of high demand and limited supply creates strong upward pressure on prices. Global economic factors also play a role. Governments worldwide continue heavy spending programs, funded by money creation. That reduces the purchasing power of paper currency over time. Gold and silver, on the other hand, cannot be printed, making them reliable stores of wealth. This is why disciplined stacking, regularly buying small amounts over time, can protect and grow your wealth, even if short-term prices fluctuate. Another factor influencing silver is investor behavior. Many people follow media headlines and panic when prices dip. But volatility is normal in metals markets, especially in silver. Paper markets amplify this because leveraged positions can trigger forced selling. Physical buyers, however, are insulated from these swings. That's why focusing on physical silver and gold rather than paper exposure is critical for long-term strategy. Carrie, let's talk about strategy for newcomers. What would you advise someone just starting with silver and gold? Carrie, start small, buy consistently, and focus on physical metals. Don't chase price spikes or drops. Understand the difference between owning physical silver and trading paper silver. Even a few ounces accumulated regularly will grow into a meaningful position over time. Exactly. Small, disciplined purchases outperform reactive strategies. For instance, buying 1 ounce of silver today at around $76 and continuing to stack periodically creates security against inflation and currency depreciation. It also positions investors to benefit from future industrial demand, which isn't going away. It's also worth noting that collectible silver and starter packs can be ideal for beginners. Some dealers offer packages with a mix of coins or small gold units at affordable prices. These packages allow new investors to gain exposure without overextending financially, while also learning the basics of stacking. Finally, it's essential to watch global developments. Currency devaluation, export restrictions, geopolitical tensions, and energy policy changes all influence metals demand. Investors who stay informed can act strategically, rather than reacting emotionally to short-term price movements. The takeaway here is simple. Silver and gold are moving because structural factors are in play, not just speculation. Physical scarcity, growing industrial use, global economic policies, and investor behavior all intersect to drive prices. Those who understand this and invest strategically stand to gain over the long term. Continuing our analysis, let's take a closer look at the historical performance of silver and gold, and what lessons we can draw for stacking in 2026. Understanding the past is crucial because metals often behave consistently under similar economic pressures. Historically, silver has been more volatile than gold. That's both a risk and an opportunity. For example, in past decades, silver experienced rapid surges during periods of economic uncertainty or high industrial demand. In 2011, silver spiked to nearly $50 an ounce before pulling back. Gold, on the other hand, tends to move slower, acting as a long-term store of value. Investors often combine the two: gold for stability, silver for growth potential. One key factor is the gold to silver ratio, which measures how many ounces of silver equal 1 ounce of gold. Historically, it has averaged around 60-65, but it can fluctuate significantly. A high ratio often signals silver is undervalued relative to gold, making it an attractive entry point for long-term stacking. Currently, the ratio is narrowing, suggesting that silver's price may continue to climb faster than gold's. Let's also consider the role of fiat currencies. Governments continue printing money to fund spending programs worldwide, eroding purchasing power. Unlike cash, gold and silver cannot be printed, making them effective hedges against inflation. Over decades, holding physical metals has preserved wealth even when local currencies lost value. This is particularly important for those who want long-term financial security rather than short-term trading gains. Industrial demand adds another layer. Silver is critical for electronics, solar energy, medical devices, and other applications. That demand is structural, not speculative. As global industries grow, the need for silver increases, putting upward pressure on prices. Unlike gold, which is mostly an investment metal, silver's industrial usage amplifies its growth potential. Carrie, from your perspective, how should investors balance these factors when deciding how much silver versus gold to hold? Carrie, diversification is key. Gold provides security and stability, while silver adds growth potential due to industrial demand. For most investors, a 50-50 split works well, but even a smaller allocation of silver can significantly enhance long-term returns. The important part is consistency. Regular stacking over months and years is far more effective than trying to time peaks and troughs. Exactly. Regular purchases prevent emotional reactions from dictating investment decisions. Even small stacks, acquired consistently, can grow into a substantial portfolio over time. For example, someone who started stacking silver in 2015 at $22 per ounce has already seen significant growth in purchasing power today. That's the power of long-term accumulation. Another consideration is access to metals. Many dealers offer starter packs, collectible coins, or small bullion pieces, making it easier for beginners to start stacking without large upfront costs. For those who want to hold physical silver, these options are practical and affordable while also providing exposure to a tangible asset. Finally, understanding global events is critical. Geopolitical tensions, such as conflicts in the Middle East or economic instability in major economies, affect investor behavior and metals demand. Countries like China, which control large portions of the silver supply, also influence pricing through export restrictions or industrial policies. Staying informed allows investors to position themselves effectively rather than reacting to short-term market noise. The takeaway from history is clear. Silver and gold are proven stores of wealth, particularly during economic uncertainty. Volatility is normal, but physical metals consistently retain intrinsic value. By stacking regularly, diversifying between silver and gold, and staying aware of global trends, investors can protect and grow their wealth over time. Now let's move into the practical side of stacking silver and gold, focusing on how investors can acquire metals, navigate market challenges, and make smart decisions in 2026. Understanding the theory is one thing, but execution is where long-term wealth is built. First, let's talk about where to buy silver and gold. For physical silver, many investors use reputable bullion dealers, both online and in person. Dealers often provide a range of options, from collectible coins and bars to starter packs for beginners. Starter packs are particularly useful because they allow new stackers to gain exposure without committing large sums. Even a small, consistent purchase plan can accumulate significant metals over time. Another option is government mints. In the US, the United States Mint and other national mints occasionally offer silver coins or medals at prices close to spot. These can be excellent deals for buyers who want physical ownership without high premiums. The key is timing and monitoring inventory, as demand often exceeds supply, and pricing can change quickly. Carrie, for someone just starting, what would you recommend in terms of quantities and types of metals? Carrie, start small and focus on consistency. 1 or 2 ounces per month of silver or a small fraction of gold is enough for beginners. Over time, these purchases add up. Prioritize physical metals and gradually diversify between coins, bars, and small collectible pieces. The goal is steady accumulation, not chasing market highs or lows. Exactly. Consistency is the secret. Many new investors get caught up trying to time the market, but silver and gold are long-term assets. Volatility is normal, and short-term price swings should not dictate your decisions. Next, consider geopolitical and economic events. In 2026, tensions in multiple regions, such as the Middle East, Venezuela, and parts of Asia, are influencing metals markets. Political instability often drives demand for tangible assets because investors seek security in scarce physical stores of wealth. Similarly, central bank policies, currency printing, and inflation trends directly impact the purchasing power of cash, making metals more appealing. We should also address the paper versus physical debate. Futures and ETFs are convenient, but they carry risks. Leverage and margin calls can trigger sudden price swings, while physical metals provide control and security. Investors holding physical silver or gold can weather market turbulence without being forced to liquidate positions due to margin requirements. For beginners, physical ownership is essential. Even small quantities, stacked consistently, create a portfolio insulated from both inflation and currency devaluation. Over time, these small stacks compound into significant wealth, particularly if industrial and geopolitical pressures push silver and gold prices higher. Carrie, let's discuss storage. How should investors keep their metals safe? Carrie, security is crucial. For small amounts, a safe at home may be sufficient. For larger portfolios, professional storage facilities, like those recognized by the London Bullion Market Association, offer insurance, security, and peace of mind. Choose a provider with a strong reputation and transparent procedures. Right. Proper storage ensures your metals remain secure and accessible when needed. Physical ownership is only valuable if it's protected. Finally, we should talk about market education. Understanding historical trends, global supply-demand dynamics, and geopolitical developments empowers investors to make informed decisions. Follow trusted sources, track industrial demand, and watch central bank policies. Education combined with disciplined stacking is the most effective strategy. In summary, practical silver and gold investment involves consistent physical stacking, diversifying between silver, gold, and collectible coins, monitoring global and economic trends, securing metals properly, staying informed and avoiding emotional reactions to short-term market swings. First, let's recap the main takeaway. Consistency beats timing. Investors who accumulate silver and gold regularly, even in small amounts, build long-term security. It's not about buying at the absolute low or selling at the perfect high. Those moments are unpredictable. What matters is steady stacking, combined with knowledge of the market and global trends. Physical metals remain central to any strategy. Futures and ETFs are tools, but they come with risks. Margin calls, leverage, and market manipulation can all create unexpected losses. Physical silver and gold give you control over your assets. You can store them securely, hold them through economic turmoil, and know that your wealth is preserved regardless of currency depreciation. Geopolitical tensions continue to play a big role. Events in the Middle East, Venezuela, and even Asia influence investor behavior. When uncertainty rises, physical metals often see increased demand. These crises may seem distant, but they affect global supply chains, industrial demand, and ultimately, prices. Smart stackers watch these trends and use them to position themselves rather than react emotionally to headlines. Industrial demand is another driver, especially for silver. Solar panels, electronics, and medical devices require silver, and that demand is structural, not speculative. As green energy adoption grows, silver's industrial use will expand, providing additional upward pressure on prices. Gold, on the other hand, continues to act as a store of value. Many investors combine both metals to balance stability and growth potential. Next, let's talk strategy for beginners. If you're new to stacking, start small, buy consistently, and focus on physical metals. Starter packs, collectible coins, and small bullion pieces are ideal for building a portfolio without overextending financially. Over time, these purchases compound, and even a modest monthly investment can grow into a meaningful holding. Storage is key. Small amounts may be kept in a secure home safe, but larger portfolios benefit from professional storage facilities. Choose a reputable vault that is insured, recognized by associations like the London Bullion Market Association, and offers transparency and accessibility. Protecting your metals ensures that your strategy delivers its intended security and peace of mind. Carrie, for someone considering their first stack this year, what final advice would you give? Carrie, focus on education and patience. Learn how the metals market works, understand supply and demand, and follow global developments. Don't chase short-term trends. Instead, commit to consistent accumulation and safe storage. Over time, that approach outperforms speculative strategies. Exactly. Knowledge plus discipline is the winning formula. Avoid emotional reactions to price swings or sensational headlines. By staying informed and stacking steadily, you safeguard your wealth and take advantage of the long-term upward trajectory of silver and gold. Looking ahead to 2026, we see several key trends. Continued industrial demand for silver. Ongoing geopolitical uncertainty influencing metals markets. Central bank policies and currency devaluation boosting the appeal of physical metals. Increased accessibility for new stackers through smaller packages, collectible coins, and starter kits. For experienced investors, these conditions create opportunities to adjust allocations, explore new types of bullion, and monitor industrial trends. For beginners, it's a chance to enter the market thoughtfully, building a foundation that can grow over years. Finally, remember the simple rule. Preserve wealth, don't speculate recklessly. Silver and gold are long-term assets. Treat them like time capsules. You place them in your portfolio today, and they protect your purchasing power tomorrow. Thank you for joining us throughout this multi-part series. Stay informed, stack wisely, and keep a long-term perspective. The markets may be volatile, but with discipline, knowledge, and patience, silver and gold remain powerful tools for wealth preservation.